You are welcome to my YouTube channel. In today's video, we're going to be covering Forex trading for beginners. Is a complete course, a professional course, an online course for beginners, for those that are starting out on Forex trading. So in this course, we are going to be covering how to be a Forex trader, how to master the skill of Forex trading, things that you need to know, and then how you can develop your own strategy to become profitable in Forex trading. Because Forex trading is, if you take it serious and you are committed to the application of the things you'll be learning in this course, all right, is going to be a series. It will help you to be independent trader. You don't have to depend on signal or anything. So let's dive into the video. But before we do that, I would like you to subscribe to this channel. It's an encouragement for us to keep on creating quality content and informations like this, because it's a free course on Forex trading, all right, without any charge. So please try to subscribe and also like this video. And then if you have any question, you can put it on the comment section. Any question, any boiling question, you can put it on the comment section. So let's dive into the video. You're highly welcome. So this is first lesson on this course. This is the first lesson on this course, and we're going to be considering Introduction to Forex. Introduction to Forex. This is the person that is bringing this video to you. God did well. What is Forex? So maybe you have been hearing about Forex trading in one way or the other. You have heard about it. What is actual Forex? I want to let you know that we have participated in Forex in one way or the other. If you're a business person, you're an importer, or you might have participated in Forex directly or indirectly. Because when you go to import goods, you have to convert, for instance, if you're a Nigerian, you have to convert your Naira to dollar. And that's Forex that you did. That's foreign exchange. Forex simply means foreign exchange. All right, so let's go to the definition. So Forex is just just an abbreviation. The full meaning is the foreign exchange. So Forex market is a global, decentralized, or over-the-counter market for the trading of currencies. Forex is simply a global market for the trading of currency. It is a decentralized market. You can also call it over-the-counter, OTC, for the trading of currencies of the world, different countries of the world. That's what we do in Forex trading. This market determines Forex exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at current or determined price. Forex market is run OTC, meaning over the counter. It is not something it's not the kind of market you might be thinking, I have to go to a physical place in order to set up my own store. No, Forex is run over the counter. If you want to start trading now, all you need is just your phone to download the platform, open an account with a broker, and you are good to go. All right, so it's traded 24 hours. Forex market does not close. It runs 24 hours round the clock, 5 days a week. So it doesn't close maybe around 5 p.m. that the market closes. No. As this section is closing, you are still going to see it in this course. As this section is closing, another section in another part of the world is opening. The 5 days in a week. All right. So Forex market is the largest market in the world. You have to note it. That is the reason why it is encouraging for you to start Forex trading. It is encouraging for you to learn the skill and treat it as a normal business. Forex is just like any other business. If you master the skill, you can use it to create for yourself a very strong source of income that can even help you to gain financial freedom and even drop your 9-to-5 job. So, but you have to master the skill, because just like any other skill, skill is the most important thing, not the money. So Forex market is the largest market in the world. It has daily transaction of over $6.3 trillion per day. But for stock markets, if you compare it, stock market is around, their turnover on daily basis is around $500 billion. So you see the gap, Forex is the largest market in the world. So if you can be able to develop the skill that I will be teaching you in this course, all right, if you be learning the skill, if you get yourself committed and you are applying the information you'll be getting here and you are consistent, you will position yourself to just capture some percentage as small as possible, small percentage of this 6.3 trillion on daily basis, and you are good, you are fine. So I want to encourage you to be serious with Forex trading, because it pays if you are willing to give it what it takes. All right. So there are some certain things you need to know, just like any other business, you need startup capital, you need, some research, things that you need to put in place to start a business. So for Forex trading, the startup capital is number one, the skill, and then as small as $100, you can start up the business. As small as $100 or $200, you can start up the business. But you see the advantage, unlike other businesses, you can't do that. You hardly see a business that you can start with $100, because you need to pay rent and so many other expenses. So two of them are not equal. Note it, two of them are not equal. The skill is the king, while the capital is the queen. Two of them is important. You need the two, you need both. I'll be teaching you, you will see the importance of both of them. Yes, the capital is very, very important. You need capital if you have to be making some, reasonable amounts of money on daily basis. But the skill is the king. If you don't have the skill, you will not be making anything. Just like being a medical doctor, if you didn't get the skill of medical doctor and you are a practitioner and expert in that skill, nobody will employ you. No hospital is willing to employ you and pay you a higher amount. All right. So the skill is the king. Focus on the skill. As you are, maybe you have been hearing about Forex trading and you may think it's a get rich quick scheme. Forex is not. It's just like any other profession. Just master the skill and you can give yourself financial freedom. So the skill is the king, while the capital is the queen. All right. Benefits of Forex. Let's look at the benefits. Low capital is one of them. I've talked about low capital, as little, as small as $100 or $200. Minimal time commitment. You don't need much of your time, unlike 9 to 5, where you go out from your house around that kind 8 a.m. or 9 a.m. to come back around 5 p.m. So Forex is not like that. Your 3 to 4 hours a day you are devoting to this career can make you grow and become a professional trader. All right. So it demands lesser time comparing to other profession. No import or export duty, no employees. All right. No physical office. You trade from anywhere. Don't need any physical office. Expenses is reduced to the highest level. This no physical office. You can trade Forex from any part of the world. You can even be on a travel and you can still place trade from your phone or your laptop and make cool amounts of money. So there is no physical office. All you need is your computer, internet connection, and the skill. That's what you need. And you'll be generating consistent profit. It is possible to be generating consistent profit. I want you to know all these things you see on YouTube or in social media, whereby they are talking about flipping $100 to $10,000. Those things are not realistic. The person might do it today, but tomorrow he will not tell you again, but he might have lost everything. 99% of people that are trading with that pattern are not able to retain their money. All right. According to analysis, the highest you can be making and be able to be consistent and keep it is from 5% to 20% of your capital on monthly basis, which is very, very okay. You don't need to be thinking of flipping your account, all right? Because those things, the risk management, they are risking much. They are risking much. But in Forex, as a professional, one of their characteristics is that they don't risk more than 1% of their capital. At most, they risk 2%. So if they are trading with $100, they risk $1 per trade or $2 per trade. And somebody that has $100 and you lost $2, $1, you see that there is no cause for alarm. So, but where you are trying to turn the $100 to $1,000, you are now risking all the whole $100. You can lose it in a second, and that is not a good lifestyle. It's not a good trading lifestyle. All you need is to manage, to know how to trade this forex, to be consistent in generating profit. And it is not with the mindset of flipping account. It is learning the proper knowledge to be consistent, the proper risk management knowledge to be consistent. That's what you need, and not thinking of flipping account. So that's it. Then in forex trading, there are different sections. I said that forex trading is 24 hours round the clock. It doesn't close. There are different sections. So all you have to do is to know the section that works in your area. So this is London section, New York section, and then we have the Sydney section, and then Tokyo section. In London section, what is active? The currency that is active in London section is Great Britain pounds. Great Britain pounds in London section. So, and if you are from Nigeria, according to West African time, Nigerian time, London session starts 8 a.m. to 1 p.m. Then for New York section, the currency that is active in New York section is United States dollar. This currency is highly volatile around this section. You know, not just the currency alone, you know, when it is paired to another currency, that's what I mean. But when, for instance, you are trading United States dollar card, around that kind, this New York section starts by 1. All right, so when United States dollar card, Canadian dollar, you are trading that currency pair, you will discover that they become most volatile during this section when the New York section is on. That does not mean that they are not volatile in other sections, but they tend to be highly volatile in this section. For that of Sydney section, you have this currency, Australian dollar, to be highly volatile, and it starts around 1 a.m. Then for that of Tokyo section, it is volatile. The currency that is volatile in Tokyo section is JPY, Japanese yen. So I just want to use this to demonstrate to you what I am talking about. So the L stands for London section, and the N stands for New York section, and then the S stands for Sydney section, and then the T stands for Tokyo. So these are the currencies that tends to be most volatile during these different sections. We also have Frankfurt. I didn't include it here. Frankfurt section. All right. You know, all these things are important that you get to know them. Frankfurt section is Euro. That is highly volatile during this section, Euro. So Get to know them so that you know the section you will be trading in the future. All right. So that's it. You need to master them as a Forex trader. Forex basics. Forex basics. As a Forex trader, there are basics that you need to master. All right, there are basic things that you need to know. There are basic terms that you need to get yourself used to. That's what makes you a Forex trader. Forex is quoted in currency pairs. Each currency is given a 3-letter code. Major currency symbols. We have the euro, we have the US dollar, we have the British pounds and all of that. This one is exotic pegs. All right, I'm still going to talk on that later on. So these are major pairs: Euro USD, USD JPY, Great Britain pounds USD, USD CAD, Australian dollar USD, New Zealand dollar USD, and USD CHF. These are the major pairs. And then take note, it is advisable for you to limit your trading within the major pairs above. That's what I mean by I'm going to emphasize on that exotic pairs. You know, those exotic pairs, it's just like trading United States dollar versus Nigerian naira. The margin, the spread is too much. All right, it's not encouraging. Trading it is not that encouraging. You can, but it is not that encouraging. But these ones, their spread is very close. Your TP, your take profits, can easily hit within the day or within the time you set it. But other ones, all these exotic pairs, some of them, their spread is very wide. Some brokers are not even offering it. Do you understand? So that's one of the disadvantages. So it's very, very advisable for you to limit your trading within the major pairs. How to calculate the currency pair? How to calculate the currency pair? Before you do that, let's take note that PIP is one of the terms you are going to get to know. And what is PIP? PIP is just the smallest change in value in a currency pair. The smallest change in value in a currency pair. Currencies are quoted in pairs and mostly in 4 decimal places, except the JPY pairs. Other currencies are quoted in 4 decimal places, except the JPY pairs. What do I mean? Example, Great Britain pounds USD. So with this currency pair now, this is the way you see it in the Forex market. That Great Britain pounds USD, for instance, today is 1.24002. What do they mean? What do I mean by the currency are quoted in pairs and mostly in 4 decimal places? Now look at what I mean here. This is a 5 decimal places, but this last one, these two, the last two in this decimal place here is not included. It is called pipette. It is not included. So this 4 value, all right, this 4 value, this you have the 1, 2, 3, 4. These are the 4 decimal places we are talking about. So this is the 4 decimal places that most currencies are quoted in. All right. So, but this one now is called pipettes. This one now is called what? Pipettes. 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 Sorry, don't mind my handwriting. All right. So this last one is called pipette. You don't have to include it, but these 4 places is the pips. This is where you calculate your pips. So for instance, the market moves from 1.2400 to 1.2402. What it means is that the market has moved 2 pips. Do you understand? What it means is that the market has moved 2 pips. Okay, so if the market moved from, maybe you bought this currency pair at this level, at this value now 1.2400, and the market moved from 1.2400 to 1.24002. Let me use another color. Let me use another color here. Let me use white. So that the market moved to 1.24002. What it means that it has moved 2 pips. All right. But if you sold at this pair, at this place, and the market moved from 1.24 at the said direction, what it means that the market has moved 4 pips. It's that simple, very, very simple. So calculating your pips is very, very easy. It's very, very simple. Just start from this place and start counting it. All right. In calculating your pips, you start from your left or from your right side and go into this direction. That's how to calculate pips. It's very easy. The another thing is about, we talk about base currency, and we say that the first currency in this currency pair now, the first currency here, this first currency here in this currency pair is called the base currency. Why this USD here, the second currency in a currency pair is called the quotes currency. All right, it's called the quote currency. Take note of that. So you see that the first currency in a currency pair is called the base currency, while the second currency in a currency pair is called the quotes currency. Note, the base currency, let me clean this so that you will see it very well. All right. So take note of these things, and these are things that will help you as a beginner. It will help you so much. Note, the base currency always has a value of 1. In this case, 1 Great Britain pounds is equivalent to 1.2400 USD at that point. So the base currency has a value of 1. It always has a unit value. All right. It has a value of 1. So for you to get 1 Great Britain pounds, you need to bring 1.2400 so that they will give you 1 Great Britain pounds. If you bring 1.2400 USD, they will give you 1 Great Britain pound. So the base currency always takes a value of 1. That's what they are just saying in essence. 1 pip in most pairs is 1 pip is what? 0.001. So it's equated to 4 decimal places. This is for all other pairs except JPY pairs. The JPY pairs are quoted to 2 decimal places. The JPY pairs are quoted to 2 decimal places. The JPY pairs are quoted to 2 decimal places. So 1 pip in JPY pairs is what? 0.01. All right. I hope you are following the whole thing. It's very, very important for you to master this beginner's level. Another example for us here is AUD JPY and USD CAD. Now, let me know whether you are following what I am saying. Let me know whether you are following what I'm saying. This AUD JPY, which one here is the base currency? Which one here is the base currency? The base currency here is what? AUD. According to the definition. Sorry. According to the definition, what did I say? is the base currency, the first currency in a currency pair. So this AUD JPY is what? This AUD JPY is a currency pair. And then the first currency here is this AUD. So this first currency here is the base currency. Why JPY is what? Is what? The quote currency. All right, I hope you said the quote currency. That shows that we are following. So, but if you didn't understand my formal explanation, you can go back to the, you can just watch the video again and again, and then you will get used to it, because you need it to be a professional Forex trader to be successful. You need all these things working together will produce you an independent day trader. So AUD-JPY, the base currency here is the AUD, and the quote currency here is the JPY. The same thing is applicable to USD CAD. The base currency here is the USD, while the quote currency here is the CAD, Canadian dollar. All right, so that's how to do it. For instance, let's calculate the pips once again. Let's see if we are understanding it. Let's say that AUD-JPY is equals to 9 point, let me take this as point, 9 points, no, let me clean it. So let's say that AUD-JPY is 89 point 1 2 1 2 3, 89.123, and it moves from this 1 2 3 down to 1 0. All right, 89.10. How many pips have you made? For instance, that you went short, you sold at 89.123, and I've told you that the last all the JPY pairs are quoted to 2 decimal place. So this last figure here is called what? It's called pipette. So you don't count it, it's not counted. All right, so it is quoted to these 2 decimal places. For other pairs, it's 4 decimal places. Only JPY pairs is quoted to 2 decimal places. So this market moves from 89.12 to 89.10. How many pips has it moved? The simple answer is 2 minus 0 is what? Is equals to 2. And that's your pips. That's how to calculate your pips. It's very simple. For that of USD CAD, you can do the same thing. If, for instance, USD CAD is 1.2240. All right. So 210, let's say 5. Let's add the pipette, but let it not confuse you. And it moves, you sold at that level, and it moves to 1.2200. So how many pips have you made in this trade now? It's simple, just 40 minus 0, 0. 0 minus 0 is 0. 4 minus 0 is what? 4 minus 0 is 4. So you have made 40 pips. You have made how many? 40 pips. So that's how to calculate your pips, whether it is on the 4 decimal places for this pair now, or these ones that are quoted in 2 decimal places for this JPY pairs. So it's as simple as that. I hope you understood the issue of pips and how to calculate your pips. You need to know it, because any amount of money you make, is not straight to the money, even though you might be seeing the money, but you need to know how many pips you are targeting per trade. And that's how to be consistent, that this is the pips I'm targeting per trade. And from there, you will get to know how much you are risking and how much you are willing to let go. For instance, the market didn't go in your direction. So this calculation is very, very important. That is why it came so early. All right. So we have done the mathematics that is involved. Now let's consider lot size. What is lot size? What is lot? Lot in Forex simply means the unit to measure the amount of the deal. The unit you use to measure the amount of the deal. A standard lot is 100,000 units of the base currency. I hope you still remember what I said is the base currency. The first currency in a currency pair, the first currency in any currency pair is the base currency. So a standard lot is 100,000 units of that base currency. For instance, if you buy one standard lot of Great Britain pounds USD, you are buying 100,000 units of Great Britain pounds with the United States dollar. All right. So that means if, for instance, that it is equal to Great Britain pounds, let me explain a little bit. If it is equals to that, this Great Britain pounds USD, okay, is equals to 1.242400. So what it means is you need to bring $124,000 to get 100,000 units of this Great Britain pounds. You need to bring $124,000 to get this. So 100, if you are buying a standard lot of any currency pair, the 100,000 units of that base currency is what you are trying to buy with the quote currency. All right. To simplify everything, the monetary value for one pip with standard lot size is 10 USD. So we have done the mathematical aspect and we are getting this result. So the standard lot, all right, for the standard lot size is $10 for one pip with standard lot size is $10. The mini lot size is $1, and then the micro lot size is 0.1. Note, in MT4 or MT5, in MetaTrader 4 or 5, any of these trading platforms that you'll be using, for me, I use MetaTrader 4. What you will see in as a standard lot is not this monetary value. What you'll be seeing there is just one. The standard lot size, if you want to use a lot size, and they said, for instance, your trainer or the person that is mentoring in Forex says, in that place, put one lot. We're going to use one lot to buy this market. What you see in MT4 is not $10. What you see there is one. And that for mini lots, what you see there is 0.1 to 0.99. So you can put 0.1 as a mini lot, can put 0.2, 0.3, and all of that to 0.99. But immediately you enter 1 or 2 or 3, you are already using standard lot size. That of micro is 0.01 to 0.09. How to get the above value? Standard simply means the benchmark. So we're going to use the standard. So to calculate the above, divide everything by the standard, which is 100,000 units. So for that of standard lot, how we get this one that you see in MT4 is just 100,000 units divided by the 100,000, which is the benchmark, which is the standard, and you get what? 1. For that of mini lots, divide 10,000 by 100,000 and you get 0.1. That of mini lot, micro lot, you will get what? Divide 1,000 by 100,000 and you will get what? 0.01. So that's how to calculate your lot size. How to relate your lot size to the profit or loss you record. Note, to convert the lot size to money, you multiply it by 10, which is the standard. Whatever is the lot size you use to trade, you multiply it by 10. Let's take, for instance, that we went long on Great Britain pounds USD at 1.2400, and the market moved to 1.2440. So the first question is, what is your pips? Let's do this simple calculation, and we are done with this. I believe that by now you should have understood it. So the currency pair is Great Britain pounds USD. You can even do it by yourself, and then you can put it in the comment section for me, showing that you're understanding it. So what is the answer here? What is the pips? What is the pips? Before I solve it, what is the pips? The market moved, you went long. You went long simply means you bought this currency pair at this value. So you bought it when the market value is what? 1.2400. So, and the market went to 1.2440. Market moved to 1.2440. So this first value didn't change. It's this 440 that we're going to just use. So it's just simple. 2440, sorry, not 2444. 442. What we are going to do is just 4 minus 0 is 4, and 0 minus 0 is what? 0. So we have 40 pips here. That's the first question. First question, we have solved it. I don't know whether you got it by yourself. All right, but it's important that you understand it. So that is the simple way to calculate your pips. There is nothing difficult in it. What is your monetary value if you used one lot size, 0.1 lot size, and 0.01 lot size for each trade? What is the monetary value? So this is where I'm going to wrap it up in terms of pips and all of that. So I say that to convert the lot size you used in any of your trade, multiply it by 10. 10 is the standard. So for instance, that you used, let's solve it for that of, let me change the color of this pen. For instance, that you used, for that of a one lot size, let's do it. For instance, as you used one, what it means is one, the lot size you use. This is the lot size. This is the lot, okay? This is the lot that you used. So 1 times 10, which is the standard, the benchmark, all right? Anything you are using, any lot size you are using, times how many pips you made. That's the formula. Times pips. Times pips that you made, you took in that trade, whether profit or loss. So this is how you can calculate your loss before you take a trade, and you are trading like a professional because you are willing to maybe lose $4 to gain $8, or to lose $10 to gain $20. So it's very simple. It's equals to the monetary value, the M, the monetary value. So in this scenario, we used one lot, which is equals to 1 times 10, all right, times our pips is what? Our pips we made here is 40 pips times 40. So what is the answer? What is the monetary value here? It's very, very simple. The same thing is what you are going to do in the aspect of 0.1. The same thing you're going to do in 0.01. So 40 times 10 is what? is 400. So you have $400. $400. That's the monetary value. Very, very easy. If you pay attention to this, you don't have to struggle in terms of calculating your pips and all of that. So that is for somebody that used one lot size to take this trade. For instance, that another person used 0.1. How much do you think is the monetary value? Can you solve this one by yourself? Somebody that used 0.1. How much do you think is the monetary value? And somebody that used 0.01. How much do you think is the monetary value? Just simple multiply by the standard, which is 10, and you multiply it by the pips you have made in that trade, whether sell or buy, whether it's a loss or profit, and you will get the monetary value even before the trade hits the take profits or the stop loss. So for that of 0.01 times 10 times 40, all right, is what? Times 10 times 0.1. So that's what? That's $40 for somebody that used. That's why I said in the beginning that you need capital to make much gain, but it is when you must have learned the skill. When you must have learned the skill, not might. When you must have learned the skill. All right. So somewhere that you two of you took the same trade. Maybe your mentor took the same trade and sent it to you. You entered the trade. You used 0.1, but himself as the big guy used one lot. He will be making $400 from the same trade, while you are making $40. That's just the difference in this issue. Let's look for somebody that is just a beginner that used 0.01 lot size. So someone that used 0.01 times 10 times 40, that's $4. That's where capital comes in. You see that others are making $40, so I'm making so I'm making $400. You are making $4. So this way, when you have learned the skill now, you can now look for capital. And there are companies that are willing to give out their capital if you have the skill for you to manage for them and you people share the profits. That's one beautiful thing about Forex trading nowadays. So that's why I say that the skill is the king. That's what you need. And your capital is the queen. The capital is the queen. You don't need much of capital when you know what you are doing. So I believe that with this example that you have understood everything about pips and lots, lot size and all of that. I don't think you will find it confusing again. If you didn't understand it very well, you can still go back to the video to watch it again and again. So the next thing is leverage. What is leverage? This is the use of borrowed money called capital to invest in a currency. By borrowing money from a broker, investors can trade larger positions in a currency. Some brokers allow traders to leverage up to 1:100, even 1:500, which has side effects. So leverage is simply money that brokers are willing to give you for you to use to trade the Forex market. You don't have up to $100,000 to trade one lot size, but you can deposit $1,000, and with that your $1,000, brokers will give you power. So leverage is just a buying power, all right, that you can leverage on, that you can hang on, and you'll be able to use one lot size. Normally in Forex trading, this lot size issue that I just explained right now, if you don't have up to $100,000 in your account, you ought not to use one lot size. But with the help of leverage, depending on the leverage you are using, that broker you'll be using tomorrow, or you're already using, will be giving you, or has already given you, with that leverage, you can use it to be using one lot size, even though that what you deposited in your account is just $1,000, and you'll be using one lot size because of leverage. But on a normal basis, what you ought to use means around maybe 0.1 or 0.01. So leverage is good. Some are willing to offer you 1:100 or 1:500. The higher the leverage, the higher your potential, your buying power, but it also had side effects. When the market is in loss, the same way you can make maybe with $1,000, you can make maybe $5,000 or $10,000. In the same way, you can even lose the whole $1,000 with high leverage. So it is not as encouraging to use high leverage. All right. So for a leverage of 1:100, it means that you can buy or sell 100,000 USD with just a deposit of $1,000. 1,000 USD margin. With just a deposit of $1,000, you can buy $100,000. That's leverage of what? 1:100. Think of when you are using 1:500. So the higher the buying power, but it is also at your own risk. You are doing it, it might harm you, it might help you. All right. So just look at this chart and then master it. It's very simple. This is the leverage when you are using 1:10 or 1:20 or 1:50 or 1:100. When you are creating an account with a broker, they will ask you to choose. You will do it by yourself. You by yourself choose the leverage that you will use either to kill yourself or to help yourself. So if you choose a higher leverage, your $1,000 might become $1 by the reason of a trade that went against you. You see that, and you'll be crying alone, but you were the one that chose that leverage. So choose better, choose wisely. All right. So this leverage now, if you are choosing 1:10, it means you have to deposit 10% of the capital you want to be buying. All right. It's very simple and straightforward. You can trade Forex in many ways. Just like any other thing, there are many ways to do it. There are many ways to trade Forex market. And one of the ways is that we have the scalpers, we have the day traders, we have the swing traders, we have the position traders. Who are scalpers? Scalpers are people that they use 1 minute chart and 5-minute chart to trade the Forex market. They use a 1 minute chart to watch and analyze the market. They don't stay too long in the market. Within 1 minute to 5 minutes, they have placed trade and they have taken their profits. I don't like that pattern because it will always make you to stay in the chart. You cannot do any other thing again. The next set of people is the day traders. They use 4 hours, 1 hour, and 15 minutes chart to analyze the market. I am a day trader, and by the reason of that, I've developed strategy for myself. It allows me to do other things. I have other things that I'm doing, but I'm also trading successfully. So as a day trader, it helps you to create time for other things. That's the benefit, because you're not going to be staying in the chart all the time. All you have to do is you do your analysis with maybe 4 hours time frame, higher time frame, to get the overview of the market for the day. So just as their name is, they are day traders. They place trade and they take profit or loss within the day. A day hardly passes without them taking their profit or their loss. That is for day traders. We have the swing traders. They use 1 hour, 1 day time frame, and 4 hours charts to do their analysis. These people stays in a trade maybe for 1 week. They place the trade and the trade is running maybe for 2 days, 3 days, even 1 week. The trade is still running. That's swing traders. All right. There are some people that are good at it. Maybe by the reason of their analysis, they understand that this currency pair will be trending down throughout this week. And by that reason of the analysis, they can place trade and we come back to check it by the end of the week or by the end of the 2-3 days. All right. That is for swing traders. We also have the position traders. These people are people that use 1 day and 1 week time frame. Some of them place trade and leaves it to run for months. Maybe by the combination of fundamental analysis and technical analysis, they saw that United States dollar versus Great Britain pounds or Great Britain pounds USD, that Great Britain's economy is going to get stronger while United States dollar is going to weaken by the reason of some factors, maybe political issues, or maybe one virus is coming up, stuff like that, just like when COVID came. All right. So when they have done this analysis, they can place trade and leave it to run for months, 3, 4, 5, 6 months. A trade is still running. So they are targeting maybe thousands of pips. All right. But for For day traders, for instance, these scalpers target between 5 to 10 pips in their trade. They will go 5 to 10 pips. All right, 5 to 10 pips. For day traders, that's for us, we target around 20. I target mostly I take 20 to around 25 or 30 pips. I'm okay. So that's for day traders. Then the next set of people is swing trader. This set of people target up to 100 pips to 200 or to 50 to maybe 100 pips. Let me say 50 to 100 pips or 200 pips. All right. Let's say 50 to 100 pips. Then for swing traders, for position traders, the targets from 500 pips. You see that? From 500 pips to 1,000 or 2,000 pips, because the trade will be running for maybe 1 month, 2, 3 months, 6 months. But from 500 to maybe at least 2,000 pips. That is for day position traders. All right. So, and when they have not seen the market reach these levels, they are not willing to go. All right, because they have come to develop the strategy and build it around themselves. So when you as you are starting, you have to choose one depending on the work you are doing right now. So this is where we're going to draw the lesson. This is where we're going to conclude for this first section. So second lesson is on technical and fundamental analysis, and that's my second video. It will be coming up soon. I would like you to share and like this video, subscribe to this channel. This course is a free course. All right, this is a course that other places you will pay $100, $200, $500 to learn, and it's still the same thing that I'm teaching you right now, that they'll be teaching you there. I'm even teaching you these things in a more detailed form. So subscribe to this channel, encourage me by subscribing, give this video thumbs up so that more people will see it. There are people, many that are interested in forex trading, but nobody to tell them truth or nobody to teach them free. All right, so this course is free. The second lesson will be coming up soon. Subscribe so that whenever I upload a video, and turn on the notification bell so that you'll be notified anytime I upload video, and you will learn Forex from the corner of your room free. All right. Thank you for watching, and see you next time.